Hello and welcome to Business Reporter's The Future of FinTech and Banking campaign. I'm Alistair Greener. The past year has seen household and corporate debt stock soar in Europe due to the pandemic. Governments stepped in to keep the economy afloat. EU countries took liquidity measures to the tune of €2.3 trillion, while the UK government spent £280 billion to avert a catastrophic economic shock. But furlough schemes and debt repayment holidays are set to end by the close of 2021. And without them, many businesses and households will struggle to service their debts. The European Commission is expecting a sharp rise in the stock of non-performing loans, at an estimated total cost of more than €1 trillion. To mitigate those costs, it's crucial that lending organisations forecast, manage and resolve non-performing loans in the most accurate and proactive way possible. How can technology help? Well, that's what we're going to discuss today with Terry Franklin, Global Business Development Director from Qualco. Good morning.
Good morning, Alistair.
How has COVID affected the financial system and in particular those lender institutions?
The pandemic has had a huge impact and we're expecting it to have a huge impact in terms of non-performing loans and increased delinquencies. Right now those impacts are en masse because there are a number of furlough schemes in place, there are tax breaks being given, there are a number of bounce back loans and different facilities like that, payment holidays. So we don't see the true impact of that. But if you look at the forward forecast provisions through IFRS 9 the banks are applying, they're already predicting significant losses and their provisions have increased significantly as a consequence of that. But what I anticipate will happen is a number of different organisations will start to see difficulties in terms of their cash flow, particularly those sectors maybe that have never been severely impacted in the past, such as hospitality or travel. The main issue there will be, do we return to our habits of the past and do the cash flow numbers stack up, or will they actually take a long time to build back into those kind of cash flow levels? At the same time, they've got to repay any loans that they have taken out during the pandemic period. So that's going to have a material impact on those organisations, whether they're even viable. Secondly, individuals at the moment are being protected through schemes like the furlough scheme. Whether or not there'll be an employment at the end of this pandemic is difficult to say because it will vary again by sector. And the true impacts then on their ability to repay their indebtedness or their ongoing outgoings is going to be a difficult area to pin down. So for me, it's still completely unknown, but we're starting to see some early signs of where the stresses are going to actually be borne out.
So how ready are banks and financial institutions, how ready are they for this wave or surge of NPLs that we've already talked about?
Yeah, so the European Central Bank has indicated there's likely to be over €1 trillion worth of non-performing loans across Europe. And we know that in markets like the UK, provisions have increased significantly. So banks are prepared in terms of they know that there's going to be a hit in terms of impairment across their portfolios. So they are prepared from that perspective. I think where the challenge will come is how many individuals have got forbearance measures in place and payment holidays in place that actually now go on to become more severe in terms of delinquency, and therefore the arrears levels will increase, generating higher demand to manage the volume of NPLs that will come. And then are the mechanisms in place to actually offload those NPLs to maintain appropriate capital adequacy across the banking sector? It's actually at an all-time high at the moment, but I think that's completely a false situation generated by the fact that people aren't spending as much. There is very little for people to go out and spend the money on, so savings potentially have gone up. And therefore that is giving some sort of buffer for the future. But I think the reality will hit home as we kind of go out of September and onwards.
Given the fact that we know it's coming, what can organisations do to gauge their exposure to NPLs and therefore prepare accordingly?
Yeah, so alongside the IFRS 9 forward-looking provisions calculations, just the ability for organisations to understand how different segments of their portfolio are performing, how the behaviours are changing. So we work with a number of organisations to help technology that identifies those changes in behaviour, whether they happen slowly or more quickly. But if you can take a view from a daily change in behaviours or a weekly and monthly change in behaviours, they're then able to tailor the way that you interact with those groups of customers in an appropriate manner that will allow them to come back to order, or at least put the right kind of measures in place to allow them to repair or go out and find new employment, whatever the situation is. I think my biggest concern on where this particular crisis is very different from the financial crisis is that those organisations that have got a cash flow issue are really going to need to be helped through coming back to some sort of income level that allows them to have a sustainable business. And I fear that it's kind of like the sword of Damocles will be hanging over a number of those organisations whilst they wait for that sustainability point to be reached again. And it's quite possible that you could see, organisations managing through a number of months and years, but actually in reality, things might change fundamentally, and therefore that business really needs to recognise it.
Tell us a little bit more about Qualco and where you fit into this. How do you help?
So Qualco works really closely with client organisations, and what we do is spend time understanding what their challenges are and what their needs are. We spend a lot of time looking at how their payment arrangements are managed and whether they break, and what is it about the customer characteristics that indicate that this particular pan is likely to break. And the way that we do that is we gather data, we analyse the data about those customers, and as their behaviours start to manifest as a broken arrangement, for example, we can see which of those characteristics led up to that break taking place. And in this particular example I'm thinking of, we help the client reduce those breaks by 7%.
That's the theory behind it, which is great. Could you maybe give us some examples of it in practice?
Yeah, so a very specific example is we take a portfolio of data, we analyse that portfolio of data, we can see that there are strong segments that are not going to perform, and therefore you might want to recognise that there's a current value in those and get them away from the portfolios quickly. Alternatively, you recognise also the customers that have the potential to recover. So the trick there is then to use that data to drive the interactions. So the physical activity that follows on from that is purely around how you will engage with those customers. And this is where digital interaction comes into its own. So I attempt to reach those customers through digital interactions. I record the outcomes. I use those outcomes then to reinvest my machine learning driven algorithms, and that helps me to future target those groups of customers in a different way.
So do you have any other examples you could share with us?
Yeah, I think the other key area to think about is in the use of digital. So we're seeing a huge shift to the use of digital. So if you think about the individual customers that may want to interact with an organisation, the ability to do it through a digital channel, to not have to explain themselves to an agent who's sat on the end of a telephone, is a big bonus for them. Now, actually, what we've seen is the amount of effort needed to handle calls through our digital proposition is as high as 50% reduction. And some of the key areas around setting up payment plans, being able to complete things like their income and expenditure details so that those can be captured and then they will persist in the back-end operations system that we provide. And from that, we're able to make an informed decision around what type of arrangement that customer should have in order to manage their difficult circumstances.
Could you also give us some examples of the potential benefits of your solutions?
There are several key benefits. We help organisations reduce their operational costs. We enable them to increase their collections performance. We help them reduce their bad debt numbers. And we also improve customer experience. And the way that we help them improve customer experience is by having tools that really engage with their customers in the most effective way, allow their customers to interact through the right channels, and therefore reduce the amount of effort that is needed to engage with those customers. One of the key areas is gathering data and then building models that predict how customers are going to behave. So we've done things like predicting whether a certain account will pay out with a certain third-party servicer, being able to predict that this servicer is going to operate more effectively on this particular account than another servicer, and being able to drive benefits in the region of 8 to 10% in terms of accurately identifying where that account is best placed. And that therefore reduces the bad debt levels and improves the collections and cash flow levels. The other key area actually is around the risks that a business is exposed to. So conduct risk is a huge area of concern for many organisations, and actually our tools help ensure that the business and the processes within the business are followed to the letter, and there's a full audit trail of everything that ever takes place. Again, very powerful in terms of ensuring and giving confidence to the organisation around managing and mitigating conduct risk.
Now, looking ahead, and to the future, what can we learn from this pandemic that we can actually chalk up as a lesson for the future? What can we gain from that?
Investing in the right technology and deploying it in order to drive better engagement with customers, better business efficiencies, and to reduce the impact of any downturn is a fundamental lesson. And you'd have thought that we probably would have taken that lesson on board after the credit crisis back in 2008. But we've seen a number of organisations just weren't prepared for this pandemic. Yes, I accept that there are a number of differences. Driving the organisation to work from home is probably one of the biggest fundamental changes that we've seen throughout our client base. But actually the technology should enable that to happen relatively simply. Yes, there are a whole load of risks around the resilience of the business and making sure that the business has got the appropriate security measures in place. But actually, having that kind of awareness and having that flexibility and having the tools to enable you to do that is where I would suggest most organisations should be prepared from this point forward. So if we've learned anything from the pandemic, it's to make sure that your business is resilient and can cope with any number of different changes.
That's very, very good advice, and let's hope we have learned a lot from the past year. It's been fascinating finding out more. Terry Franklin from Qualco, thank you very much indeed.
Thank you, Alistair.